how should you pick your investments inside your 401k? Now, the vast majority of 401ks in the current marketplace have really two distinct options. They have what are called target date or age date investment options, or they have actual individual mutual fund options for you to choose from. Now, most plans have some type of default that will take your birthday, and that birthday will then do a calculation, and you'll get an age date or a retirement date fund choice that will basically line up with what your expected retirement date is. Versus you would have to go in and pick, or an advisor can help you pick, the individual funds. So what's the difference and why does it matter? First and foremost, the age date funds are set. They have a system that as you get older or as you get closer to the retirement date, by default, they will get more and more conservative, moving more and more out of individual stocks or the market exposure and more and more of fixed income and bonds or less risky like investments. With the thought being is as you get to retirement, you may need more of that money, so therefore you don't have the time to have that type of fluctuation. The problem with that is, depending on where interest rates are at or depending on where the markets are at, moving more and more consistently out of one thing and into the other may not be the right thing to do in the current environment that we're in. These funds are just kind of ignore the fundamentals of the market over 10, 20-year time frames of those of you that are working. And worse, some of you that get into retirement may end up having a 20 or 30-year time horizon in retirement and actually may need to have more of that portfolio exposed to more of that growth that comes from equities, both while you're working and even more so while you're in this long-term retirement. And so sometimes age-based funds, though they're simple and it's easy to check a box and it just automates things for you, may actually have you underperform returns that you may need. How do you fix that? Well, there's two different options. Moving that date of the retirement fund farther into the future, which therefore will give you more exposure to those equities or more exposure to growth and give you a greater opportunity to try and have a better return, at least historically. The other option is you actually can go over and pick your own allocation or some allocation of both. And again, an advisor's job is to help discern what's best for you and what makes the most sense for you based on your risk tolerance, based on your time horizon. But sometimes just checking a box and completely forgetting about it may not be in your best interest.